Welcome to the deep dive. So you're here with a mission, right? To figure out how a world-class system like Six Sigma's DMAIC can be pulled from the factory floor and applied to algorithmic trading.
It really is the holy grail for any quant trader. You see that beautiful, smooth equity curve in your backtest, and you think, this is it.
And then the nightmare begins, you flip it live, and that perfect strategy just disintegrates.
It happens all the time, and I think what our sources really hammer home is that success isn't about finding some, secret entry signal.
No, it's about one thing. It's about mastering the variability of your entire trading
Yeah,
process.
exactly. And that's Six Sigma's bread and butter, DMAIC, define, measure, analyze, improve, control. It's a systematic, almost military-grade methodology for hunting down and eliminating what causes that variability.
We're treating the strategy not as some magic box, but as a production line.
A repeatable, measurable production line, yes.
Yeah. Okay, so before we jump into the framework itself, let's talk about the enemies. What are we actually fighting here? DMAIC is basically a countermeasure to all the classic ways these backtests fail in the real world.
Top of that list, without a doubt, is overtraining or, overfitting.
Right, where the algorithm learns the noise in your data, not the actual signal.
Exactly. It looks perfect on past data because it's memorized it, but it's totally brittle going forward. And right behind that is just ignoring real-world costs.
Slippage, spreads, commissions.
All of it. If your strategy's edge is just a few ticks, those costs can eat up, literally 100% of your profits.
And we still see the human element sneak in, don't we? Chaotic risk management,
Yeah.
where people just change their position size on a whim.
Or worse, emotional interference. The developer gets nervous and starts manually tweaking the parameters right in the middle of a drawdown.
It defeats the whole purpose of the algorithm.
It does. And all of this sits on top of what you could call technological naivety. Bad data, system failures, you name it.
But hold on, you mentioned overtraining. How is that really different from the other classic mistake, which is seeking patterns in randomness? Aren't they sort of the same thing?
That's a great question, and there's a subtle but really important difference. Overtraining feels more like a technical error. The machine just fit the noise too well.
Okay.
But seeking patterns in randomness, that's a human cognitive bias. It's us seeing a face in the clouds and thinking it means something. It's attributing predictive power to a total fluke.
And DMAC forces you to kill both of those demons.
It does. It just removes the guesswork. So let's start with phase one, define.
This is where we set the blueprint.
Right. We are defining the scope, the objective, what the output of this whole trading process is even supposed to be.
So step one is just absolute clarity. The output isn't just money. It needs boundaries.
Yes. You need clear, measurable goals. Let's say a 15% annual yield with a maximum drawdown of no more than 10%, or a target profit factor of, say, 1.5. No ambiguity.
And this is where we identify the CTQs, right? The critical to quality parameters.
The non-negotiables. The things that absolutely must be right. What market are you trading? Euro USD on the 1-hour chart. What's your signal type? A moving average crossover. What are your absolute risk rules? You write it all down.
And I saw the sources mention using something like an Ishikawa, a cause and effect diagram, to map all this out.
It's a great way to structure your thinking. You lay out your initial hypothesis, like, we believe a 5,200 moving average crossover effectively captures the trend. It's a testable statement.
Okay, so once that blueprint is locked in, we move to the heavy lifting, the measure phase.
And the rule here is brutally simple. Garbage in, garbage out. The data cannot be lying to you.
So this is all about data integrity.
Obsessive attention to it. Gathering the data, making sure it's complete, correcting for missing bars, scrubbing any, extreme outliers that are clearly errors.
But we're not just measuring the data, we're measuring the market itself, aren't we?
You have to. You measure its volatility, the average price moves, you measure autocorrelation, how much today's return depends on yesterday's. You have to understand the environment.
And this is where the stats get really practical really fast. The source material talks about using something like Minitab to build a histogram of your returns. Why is that so important?
Because you're checking the shape of the distribution. If that histogram shows a strong negative skew, a long, ugly tail to the left, that is a massive red flag.
It's a warning sign.
It tells you your strategy is vulnerable to severe, rare, but catastrophic losses.
So why is finding that skew right now, in this phase, so critical? What's the immediate risk?
The risk is that you're assuming a nice, clean bell curve for your returns. If you do that, you will completely underestimate how bad those big losing days can be.
So finding that heavy tail forces your hand.
It forces you to go right back to the defined phase and say, okay, that 10% max drawdown, maybe it needs to be 12 or 15. You adjust the goal because the data tells you to.
That's a fantastic feedback loop. And once that data is clean and understood, we're set up for phase 3, analyze.
This is where we stop guessing and start proving. We take those hypotheses from the defined phase and we test them.
So does that moving average crossover actually correlate with future prices? Or was it just a fluke in the backtest?
Exactly. And you bring in the statistical rigor, you run regression analysis or ANOVA tests to see if the strategy performs differently in, say, a quiet market versus a high trend market.
The sources also mentioned that financial data often isn't normal. It doesn't fit that neat bell curve.
It almost never does, which is why we often have to pivot to non-parametric tests like a Mann-Whitney or Kruskal-Wallis. They don't make assumptions about the data's distribution, which is vital when you're dealing with those market tails.
Now, wait a second. I saw a mention of using something like the augmented Dickey-Fuller test, the ADF test, to check for stationarity. That sounds computationally intense. Is that a realistic step for a smaller developer?
I'd argue it's necessary for anyone who's serious. If your strategy depends on the market having certain statistical properties,
You have to know if those properties are consistent over time.
you must. If the ADF test tells you the market behavior is non-stationary, it means the underlying physics are changing. Your strategy is basically doomed to drift and fail eventually.
So the goal of the analyze phase is to really separate the true signal from the random noise and find the strategy's Achilles heel.
Precisely. You might find that, yes, the MA5200 crossover works, but only when market volatility is above a certain level. Now you have a specific weakness to address.
And that leads us straight into phase 4, improve.
This is where we tune and optimize, but, and this is critical,
Yeah.
we do it based on planned experiments, not just by randomly tweaking numbers until the backtest looks good.
So it's evidence-based tuning. Using that example, if we know the MA crossover is good but fails in low volatility, we focus our effort there.
You don't waste time changing the MAs. You focus 100% of your effort on designing the perfect volatility filter and optimizing the stop loss for those specific conditions.
And we use tools like Design of Experiments, DOE, to test this.
Yes, and the Pareto diagram here is your best friend.
Yeah.
It will almost always show you that, like 80% of your performance variability comes from just 2 or 3 key parameters.
So you stop messing with the small stuff and just focus on the 2 things that actually matter.
You attack the root cause of the variability. But the real game changer in the improve phase, this is what separates the pros, is the robustness check.
This is where you go way beyond a simple backtest.
Way beyond. This is where you actively try to break your strategy.
So what are these tests? What does a DMAIC strategy have to survive that a normal backtest skips?
Okay, 3 big ones. First, Monte Carlo simulation.
You shuffle the trades.
You randomly shuffle the sequence of your historical trades hundreds, even thousands of times. If your equity curve is truly robust, it should survive. If the results are all over the place, it means your strategy was just path-dependent. It got lucky.
It relied on a lucky streak. Okay, what about the walk-forward matrix?
The WFM is all about addressing drift over time. You don't just run one backtest. You optimize on, say, year 1, then test it on year 2. Then you re-optimize on years 2 and 3 and test it on year 4.
So you're simulating a real-world scenario of periodic re-optimization.
You're confirming that the strategy can adapt to changing markets without falling apart.
And the third one, which I find fascinating, is parameter permutation.
This one tests stability. You take your optimal settings, let's say that MA5200, and you deliberately test MA51201 or 49199.
Just tiny changes.
Tiny changes. If a 1% change in a parameter causes performance to crash, you know you haven't found a robust market phenomenon. You've just found a random spike in the noise. The goal is to find a configuration that is stable, not just maximally profitable.
Okay, so once we have this battle-tested, robust strategy, we get to the final phase, control. This is the insurance policy.
Exactly. Control is about continuous, real-time monitoring. You're not done just because the strategy is live.
You're tracking your P&L against what you set out in the defined phase.
And you're tracking the inputs, too. But the key tools here are the visualization charts.
The control charts, like an XBAR or an EWMA chart.
Yeah.
What do those actually show you in practice?
They establish your control limits, the expected normal statistical variation of your strategy's profits. If your monthly average profit suddenly drops below the lower control limit, the chart flags it.
So it's not just a bad month.
It's a signal that something fundamental in the market has changed. The process has deviated. It's what we call drift. It means it's time to stop trading that strategy and start the DMA cycle all over again.
That's incredibly powerful. It gives you an objective signal to hit the brakes. We saw this in the case study, didn't we? That EUR-USD strategy.
We did. It was a perfect textbook example.
So walk us through how DMAIC totally transformed that simple MA crossover strategy.
Okay, so in the define phase, they set a hard target. 15% return, 12% max drawdown.
But then the measure phase immediately threw a wrench in that.
A huge one. They found that severe negative skew in the returns, which told them that a 12% drawdown was not a safe assumption at all. It was way too risky, so they had to adjust.
Then analyze confirmed the weakness.
It confirmed the MA 5200 was efficient, but it failed, catastrophically, in low volatility markets.
Which perfectly directed the improver phase.
They didn't touch the moving averages. They focused entirely on optimizing the stop loss and building that volatility filter. And they validated it not just with a backtest, but with the walk-forward matrix in Monte Carlo.
And the final result of that?
A stable profit factor of 1.7 that they knew from robustness testing would only vary by about plus or minus 0.2. That's stability.
So when they went to the control phase and took it live,
the live results were great, the drawdown stayed around 10%, and most importantly, their control charts showed the monthly profits stayed right inside the expected limits. For months.
The real outcome wasn't just profit, it was confidence.
It was control over variability. They knew that a shift in the market would cause a minor fluctuation, not a complete system collapse.
So when we boil this all down, what does it mean for you, our listener?
Yeah.
DMAIC gives you that structure, that discipline that is it's missing from so much of retail algorithmic trading.
It forces you to stop treating it like you're searching for a magic trick and start treating it like a proper engineering challenge.
The core lesson, I think, is that long-term success here is a marathon. It's driven by discipline, by data, by rigorous testing, not by intuition or panic.
And since the whole point of DMAIC is to reduce variability and stabilize outcomes, here's a final thought. Think about applying this systematic process to any area of your life, any complex decision you have to make. How could you use it to filter out the noise and find the few critical things that actually drive success? Next time you face a big challenge, don't just focus on the outcome. Define, measure, analyze, improve, and control the process itself.